On August 13, 1971, 2 days before President Nixon would close the gold window and shock the world, the Federal Reserve Bank of New York processed its largest weekly gold redemption in history, $437 million to France alone. The public had no idea. Congress had no idea. But 12 foreign central banks and the largest Wall Street dealers knew exactly what was coming. This wasn't a leak. It was a signal, one of three that the Fed has transmitted before every major monetary reset for the past 110 years. Think about what that means for just a moment. While Americans were going about their summer, planning vacations and watching their dollars buy the same goods they'd always bought, the people who run our monetary system were quietly executing the largest financial restructuring since World War II, and they were doing it in plain sight, if you knew where to look. Here's where it gets interesting. These signals weren't some conspiracy or secret handshake. They were built directly into the Federal Reserve Act of 1913, embedded in the architecture of our monetary system like pressure valves in a boiler. Section 13.3 gave the Fed power to lend to anyone in unusual and exigent circumstances. Section 14 allowed open market operations to prevent violent fluctuations. The machinery was installed from day one, designed to protect the system's core participants during moments of crisis. Not the currency itself, not your savings, the system. Picture this scene. Tuesday, March 16th, 1971. You're 80 feet below street level in the gold vault beneath the Federal Reserve Bank of New York. Central bank representatives from France, Switzerland, and Germany wait as workers load 16,000 gold bars onto pallets. That's $670 million worth of American gold, walking out the door in a single day. This single day's redemption equals what typically moved in an entire month. Meanwhile, upstairs in the discount window department, J.P. Morgan Chase and First National City Bank, now Citibank, are borrowing $340 million in overnight funds. That's triple their normal usage. And in the repo market where Wall Street funds its daily operations, interest rates on Treasury collateral spiked to 7.8%, the highest since 1966. Three signals flashing red. The public wouldn't learn the dollar was in crisis for another 5 months. Let me walk you through exactly what was happening, while most Americans had no clue their monetary system was being dismantled. In May 1971, West Germany's central bank, the Bundesbank, converts $1.2 billion in Treasury securities to gold over just 17 days. Think about that number. We're talking about a $1 billion transaction, and the Federal Reserve makes no public statement. Nothing. But if you were watching the discount window lending data, you'd see Morgan Guaranty Trust borrowing $890 million in emergency funds. That's their largest drawdown since 1933, during the Great Depression. Then in July, Switzerland quietly redeems $280 million in gold through something called the London Gold Pool, which had supposedly closed back in 1968. How did they pull this off? Through Federal Reserve swap lines, bilateral currency agreements that let foreign central banks access dollars without any public disclosure. By the time we get to July 1971, total outstanding swaps reach $3.8 billion. That's the highest level in the Fed's 58-year history at that point, and you wouldn't have seen a single headline about it. Now, we arrive at the final 2 weeks, August 1st through August 13th, 1971. France redeems $437 million in gold. Belgium takes $106 million. The Netherlands grabs $139 million. Our gold stock drops to $10.2 billion, barely covering 22% of the dollars that foreign governments could claim. On August 12th, just 3 days before Nixon's announcement, the repo market effectively freezes as primary dealers demand 9.4% interest on overnight Treasury collateral. That's panic-level pricing. The next evening, Nixon appears on television and closes the gold window. But here's what you need to understand. This wasn't a sudden crisis that caught everyone off guard. The 1934 Gold Reserve Act had established the $35 per ounce fixed price, what we now recognize as signal number 1, gold operations. That mechanism sat there for 37 years, operating quietly, until foreign central banks figured out they could use it to pressure our monetary system. When they started redeeming in massive quantities in 1970 and 1971, They were essentially reading signal number one and preparing for what would come next. What should really grab your attention is how perfectly coordinated this was. The Glass-Steagall Act of 1932, not the famous 1933 banking separation law, but its predecessor that nobody talks about, had already expanded the Fed's ability to conduct repo operations against government securities. By 1971, these mechanisms had been tested through the Depression of 1920 to 1921, the bank holiday of 1933, and the London gold pool crisis of the 1960s. Wall Street's largest institutions knew exactly how to read these signals. They'd seen the patterns before. They knew that when gold redemptions surge, discount window borrowing explodes next, and then repo markets seize up right before the public announcement. You might be wondering who was on the winning side of this reset. The 12 foreign central banks that redeemed their gold before August 15th locked in the $35 per ounce price. After Nixon closed the window, gold immediately began trading higher on free markets, hitting $42 by February 1972 and $120 by June 1973. Those central banks essentially got a 20% return in 6 months and a 240% return in 2 years, all because they could read signals that the American public never knew existed. And the Wall Street dealers who borrowed heavily from the discount window in July and August? They were positioning for exactly what happened next. When Nixon announced the end of dollar-gold convertibility, Treasury bond prices initially crashed as foreign holders panicked, but the Fed immediately stepped in with massive open market operations, buying bonds to stabilize prices. The same institutions that had borrowed from the discount window were the primary dealers selling those bonds to the Fed at supported prices. They made money on both sides of the reset. Meanwhile, if you were an everyday American with savings in a bank account, you just watched your dollars lose 20% of their international purchasing power within a year. Imports got more expensive. Your next vacation to Europe cost dramatically more. But you didn't get the 6-month warning that France got. You didn't get the 3-month window that Morgan Guaranty Trust used to position their trading book. You got the Sunday night television announcement after the reset was already complete. This is the machinery of last resort, installed in 1913 and activated in 1971. 3 signals: gold operations, discount window lending, repo market seizures, designed to give the system's core participants time to prepare while keeping everyone else in the dark. The question we need to answer next is whether this was a one-time event, a unique product of the gold standard era, or whether these same 3 signals have appeared before every major monetary reset since then. Spoiler alert, they have. And once you learn to recognize them, you'll see them flashing right now. After 1971, something interesting happened. The Federal Reserve couldn't use gold redemptions as signal number 1 anymore. There was no more gold window to close. But the signal didn't disappear. It just evolved. Because here's what most people don't realize. Our central bank and its allied central banks around the world didn't need to hold gold after we went off the gold standard, but they kept using it anyway. Why? Because gold operations, sales, leases, and swap arrangements became the perfect tool for managing dollar liquidity in foreign markets without making public announcements. Let me explain how this actually works, because once you understand the mechanism, you'll see why these signals are so reliable. When foreign central banks start accumulating gold rapidly, or when something called gold lease rates spike in London, it tells us that foreign institutions are losing confidence in dollar stability. The Fed can watch this happen in real time through the Bank for International Settlements, the central bank for central banks in Basel, Switzerland, and through the London Bullion Market Association clearing volumes. But the public? We don't get access to this data until months or years later, buried in annual reports that financial journalists rarely examine. Signal number 2, the discount window, became more sophisticated after 1971, but worked the same way. When J.P. Morgan, Goldman Sachs, or Bank of America dramatically increase their borrowing at the Fed's discount window, it means private lending markets are seizing up. Nobody wants to lend to them overnight, so they're going to the lender of last resort. The Fed publishes this data every week in something called the H.4.1 statistical release. But here's the catch: the detailed information showing which specific institutions are borrowing, what amount stays confidential for 2 years. By the time you can see who is in trouble, The crisis has already happened and the system has moved on. Then comes signal number 3, the repo market seizure. This is where Wall Street funds $4 to $5 trillion in daily operations. Banks and dealers borrowing cash overnight by pledging treasury bonds as collateral. When overnight repo rates suddenly spike above the Fed's policy rate, or when dealers start rejecting specific types of collateral, especially treasuries, which are supposed to be the safest assets in the world, the system is hours or days from a public crisis. The Fed monitors this through something called the General Collateral Financing Repo Rate and SOFR submissions from primary dealers. But again, regular investors get this information with significant delays, if at all. Now, let's see how this played out in real time. October 1987, Black Monday, when the stock market drops 22.6% in a single day. You remember this as a sudden crash that came out of nowhere. But if you were watching the signals, you saw it coming 6 months early. In June 1987, the Bundesbank, Germany's central bank, increases its gold reserves by 95 tons over just 8 weeks, purchasing through BIS intermediated swaps. At the same time, gold lease rates in London spike from 0.5% to 2.8%, the highest since 1981. Signal number 1 is flashing. Then, in August, Chemical Bank borrows $890 million from the discount window on August 19th. That's their largest discount window access since 1974. Bank of America takes $670 million on August 27th. Total weekly discount window credit reaches $2.1 billion, up from a $400 million average. Signal number 2 is now flashing. But the newspapers aren't reporting any of this because it's buried in Federal Reserve statistical releases that require specialized knowledge to interpret. October 16th through 19th, we get signal number 3. Repo rates for Treasury collateral jump from 7.2% to 11.6% in 3 days. On Black Monday, October 19th, the repo market effectively closes as dealers refuse to provide overnight funding to each other. The next day, the Fed injects $12 billion through repo operations, their largest intervention since 1933. If you were a primary dealer with access to these markets, you had 3 days warning before Black Monday. If you were a regular investor watching CNBC, you got no warning at all. Fast forward to 1998. Long-term capital management, the hedge fund that nearly brought down the global financial system. Let's trace the signals. March 1998. Central banks lease 380 tons of gold to bullion banks, double the normal quarterly volume. The Bank of England announces plans to sell 415 tons of gold reserves. Why would Britain sell gold when the price is already falling? Because they're coordinating with the Federal Reserve to suppress gold prices and keep the dollar looking strong while the Asian financial crisis spreads. Gold drops to $280 per ounce, a 19-year low. That's signal number 1, 6 months before the crisis goes public. After Russia defaults on its debt in August, discount window lending jumps to $4.8 billion by August 28th. Bankers Trust takes $1.9 billion, Chase Manhattan, $1.4 billion. The Fed has quietly waived what they call the stigma rules, penalties that normally discourage banks from using the discount window. This is signal number 2, and it's telling you that major institutions are in serious trouble, but the Fed describes this as routine liquidity management. September 23, 1998, repo rates spiked to 10.5% for overnight Treasury collateral, 300 basis points above the Fed funds target. That's signal number 3, and it's screaming that the system is breaking. LTCM's counterparties stop accepting their collateral. The Federal Reserve Bank of New York orchestrates a $3.65 billion private sector bailout. The public announcement comes September 23rd, but primary dealers knew by September 15th when repo markets first seized. You're seeing a pattern here, right? The same 3 signals, the same sequence, the same advance warning for those who know where to look. Let's jump to 2001, the dot-com bubble bursting, September 11th, attacks. Recession. September 2000, European central banks reduced their planned gold sales from 400 tons to 300 tons annually through something called the Washington Agreement. The Bank of England suspends its gold auction schedule. Central bank gold leasing drops 40% quarter over quarter, a sharp reversal that signals they're hoarding dollars. There's signal number one, 12 months before the crisis peaks. December 2000, after Enron's credit gets downgraded, discount window borrowing increases to $1.2 billion weekly average, up from $200 million in the third quarter. The Fed creates the first unnamed lending facility for securities firms through its primary dealer credit channel. They're not calling it a bailout or an emergency measure. They're calling it enhanced liquidity management. Signal number two, September 10, 2001, one day before the terrorist attacks. Repo rates spiked to 6.25%. That's 175 basis points above Fed funds, as several primary dealers face liquidity pressure from telecommunications and energy sector exposure. After September 11th, the Fed injects $81 billion through repo operations on September 12 alone. That's the largest single-day intervention in history to that point. The attacks provided cover for what was already a brewing financial crisis. Signal number three was already flashing before the towers fell. Now we arrive at 2008, the big one, the great financial crisis that reshaped our economy and politics. You were told this came from subprime mortgages and reckless lending that nobody saw coming, but the signals were there 18 months early. January 2007, BIS gold deposits increased by 209 tons in the fourth quarter of 2006, the largest quarterly increase since 1999. Russia adds 52 tons to reserves. China unofficially adds an estimated 200 tons. Gold price rises from $635 to $710 per ounce in 6 weeks, despite no apparent market catalyst. Signal number one, August 2007, the Fed announces the Term Auction Facility, or TAF. That's just a renamed discount window designed to remove stigma. By August 31st, borrowing reaches $39.8 billion. Citigroup takes $8.4 billion, Bank of America $6.8 billion, Wachovia $5.2 billion. The public is told this is a precautionary measure. Signal number two is now screaming. September 15, 2008, Lehman Brothers files for bankruptcy. That's the date everyone remembers. But look at what happens in the repo market. Overnight, Treasury repo rates spike from 2.25% to 6% by September 17th. On September 18th, the Treasury repo market requires Federal Reserve intervention of $105 billion. By September 29th, the Fed establishes unlimited dollar swap lines with 14 foreign central banks. That's signal number three, and it's the ultimate admission that all three signals have failed to contain the crisis quietly. Here's what the Fed's own research confirmed, published in 2010, after the crisis had passed and the emergency measures had been normalized. Discount window borrowing above $1 billion weekly has preceded every recession since 1950. Every single one. Yet this data remains confidential for 2 years, long enough that by the time you can access it and analyze it, the crisis has already happened, the reset has already occurred, and the system has already moved on to the next cycle. The pattern is undeniable. Signal number one appears 6 to 18 months before the public crisis. Signal number two follows 3 to 6 months out. Signal number three flashes days or weeks before the announcement that shocks the world. And each time, the same institutions, primary dealers, major commercial banks, foreign central banks with swap lines, get the advance warning, while the rest of us get the Sunday night television address or the Monday morning headline. Which brings us to a question you're probably already asking. Are these signals flashing right now? Let's talk about 2020, because what you were told about the COVID crisis and what the signals were showing are two very different stories. The official narrative says the Federal Reserve responded to an unexpected pandemic with emergency measures starting in March 2020. But if you look at the three signals, you'll see they started flashing in the fourth quarter of 2019, 3 months before COVID was even publicly known. July 2019. Global central banks purchased 650 tons of gold in the second quarter, the largest quarterly increase since 1971, since Nixon closed that gold window we started with. Poland adds 100 tons, Russia buys 96 tons, China accumulates 74 tons. And here's what should make you pause. Gold price rises from $1,280 to $1,420 per ounce during this period, even though the Fed is signaling potential rate cuts. Rate cuts typically strengthen the dollar and pressure gold downward, but gold is doing the opposite. Someone knows something. Signal number 1 is flashing 6 months before the world hears about a virus in Wuhan. December 2019. The Fed establishes overnight repo operations of $120 billion per day starting December 12th. This is the first standing overnight facility since 2008. Primary dealers borrow $47.8 billion from the discount window in the week ending December 27th, the highest weekly total since June 2009, right after the financial crisis. The Fed calls this year-end balance sheet management, routine technical adjustments. The first reported COVID case in Wuhan occurs December 31st, 2019. Signal number 2 was already screaming before anyone outside China knew the word coronavirus. March 9th, 2020. The Treasury repo market effectively stops functioning. Overnight rates spike from 1.58% to 4.25% in a single day. That's signal number 3, and it's telling you the system is breaking right now. By March 16th, the Fed announces unlimited quantitative easing, $700 billion in asset purchases, and dollar swap lines with 14 foreign central banks totaling $450 billion. Discount window borrowing peaks at $150 billion by March 27th. The public narrative attributes this entirely to COVID lockdowns, businesses closing, workers staying home, supply chains disrupted. But the signals had been flashing for 9 months before the lockdowns began. What COVID provided was cover, a publicly acceptable reason for the Fed to do what it was already preparing to do, based on signals that had nothing to do with a virus. Now, here's where it gets really interesting, and why you need to pay attention to what's happening right now in 2023, 2024, and 2025. After 2020, the Federal Reserve did something it had never done before. It made the emergency signals permanent. In July 2021, they established the Standing Repo Facility, a permanent overnight repo operation. When the Bank Term Funding Program was created in March 2024 after Silicon Valley Bank failed, it was supposed to be temporary but got extended twice. These tools that used to appear only during crises are now just part of the standard toolkit, running quietly in the background, which means the signals are harder to read now, right? Wrong, they're actually easier, because the baseline is established. When usage of these permanent facilities suddenly spikes above their normal levels, that's your signal, and they're spiking right now. Let's walk through the current sequence. Second quarter 2023. Central bank gold purchases reach 1,136 tons in 2022, reported in early 2023. That's the highest annual total since 1950. China unofficially adds an estimated 400 tons. Turkey buys 148 tons, India takes 33 tons. The People's Bank of China restarts official gold purchase reporting in November 2022 after a 3-year silence. Singapore and Poland quietly increase their reserves by 40% and 35% respectively. Gold price rises from $1,820 to $2,080 per ounce between January and December 2023. Despite the Fed aggressively hiking interest rates, which should be strengthening the dollar and pushing gold down. Signal number 1 started flashing in mid-2023, March through May 2024. Silicon Valley Bank fails on March 10th. The Fed creates the Bank Term Funding Program, another renamed discount window. Usage reaches $163 billion by March 15th. First Republic Bank borrows $92 billion, disclosed later. New York Community Bank takes $11 billion. PacWest Bank, $7.8 billion. The Fed describes this as isolated to regional banks, nothing systemic. By January 2025, BTFP usage remains above $100 billion, despite the facility's scheduled closure. Signal number 2 has been flashing for over a year now. December 2024 and January 2025. The Secured Overnight Financing Rate, SOFR, which replaced LIBOR as the repo market benchmark, shows increasing volatility. On December 31st, 2024, Overnight repo rates spike 45 basis points above the Fed's policy rate. That's the largest year-end spike since 2018, right before the 2019 repo crisis we just talked about. The standing repo facility sees usage increase from a $2 billion average to $38 billion by mid-January 2025. Treasury market liquidity metrics, measured by bid-ask spreads, are worsening to levels we last saw in March 2020. Signal number 3 is starting to flash. So, who wins and who loses when the next reset comes? Let's be very clear about this, because it follows the exact same pattern we've seen for 110 years. The primary dealers, 24 firms authorized to trade directly with the Fed, including JP Morgan, Goldman Sachs, Bank of America Securities, Barclays, Deutsche Bank, they receive advanced signals through their daily repo operations and discount window access. They can position before any public announcement, shorting assets that will decline, buying assets the Fed will support. Foreign central banks with standing dollar swap lines, the 14 institutions that can access unlimited dollars during crises including the European Central Bank, Bank of Japan, Bank of England, Swiss National Bank. Their commercial banks can operate with higher leverage than competitors because they know they have a backstop. Countries that accumulated gold during the signal phase, China increased reserves from an estimated 1,800 tons in 2019 to over 2,200 tons by 2024. Russia went from 1,509 tons in January 2019 to 2,332 tons by February 2022, right before Western sanctions. If history repeats and gold gets revalued upward during the reset, as it did after 1971, after 2008, after 2020, these nations see their reserves appreciate 20 to 40%, while everyone else watches their currency purchasing power decline. And who loses? The 63% of Americans living paycheck to paycheck, who cannot reposition their finances based on signals they don't know exist. When the reset occurs, monetary expansion, currency devaluation, their cash savings lose 15 to 25% of purchasing power within 18 months. After March 2020, inflation-adjusted purchasing power declined 17.8% through December 2022. Your grocery bills, your gas prices, your rent, they all jumped while your paycheck stayed the same. Pension funds, state and corporate, have regulatory restrictions preventing rapid repositioning. They're legally obligated to maintain target asset allocations, forcing them to buy assets at peak prices right before the reset. CalPERS, California's public pension system, lost $86 billion in market value during March and April 2020. Small and medium banks that aren't primary dealers lack direct Fed access. When repo markets seize, they face immediate liquidity pressure, while JP Morgan and Goldman Sachs borrow at the discount window. Of the 4 banks that failed in 2023, Silicon Valley Bank, Signature, First Republic, Silvergate, none were primary dealers. They couldn't read the signals, and they didn't have the access to act on them if they could. The timeline points to 2026, possibly late 2025. The 3-signal pattern operates on a 6 to 8 year cycle. We saw resets in 1971, 1980, 1987, 1998, 2001, 2008, 2020. Each signal sequence takes 6 to 18 months to complete from first flash to public announcement. Current signal intensity, gold accumulation at 50-year highs, discount window usage above $100 billion, repo volatility increasing, suggests the sequence started in the second quarter of 2023. Historical patterns indicate public crisis announcement comes 18 to 24 months after signal number 1 appears. That places the next reset between late 2024 and mid-2026. The Federal Reserve's own forecast, released January 2025, shows balance sheet expansion resuming in the third quarter of 2025 if conditions warrant. That's the same language they used before every previous reset. On August 13, 1971, 12 foreign central banks and the largest Wall Street dealers knew the gold window would close before the president announced it. On March 9, 2020, those same types of institutions positioned for unlimited quantitative easing 6 days before the public announcement. The signals exist. They've existed for 110 years. The Federal Reserve's emergency powers, Section 13.3 lending, open market operations, dollar swap lines, were built to protect the system's core participants during resets, not to warn the public. Gold operations, discount window lending, repo market seizures, 3 signals, 1 sequence, same outcome every time. The only question that matters is whether you're reading them or whether you're waiting for the announcement that comes after the reset has already begun.